Okay, so Chapter 2. Chapter 2 starts over on page 50. We're already kind of in the first Chapter 1, went through and talked about the T accounts and illustrated those, so I kind of jumped ahead a little bit. But they talk about that every transaction is going to go into an account. And an account is, like I said earlier in Chapter 1, it's either an asset, a liability, an equity, a revenue, or an expense account. So each different type of account is where we group all those transactions. So for example, in assets, where we have economic resources, an example of account would be the cash account, where we record all the cash transactions. It would be the inventory account, where we record all the purchase of the inventory that we're going to sell to our customers and then we're going to transfer out when we sell it. It would be the supplies account, where we keep the supplies expense, or the supplies asset that we're going to be utilizing. Same thing on the liability. We keep an account where we have all the accounts payable. That's where all the transactions that we have promised to pay in the future for activities related to our operations are kept. And then when we credit those when we put them in, and then we debit those to take those out. So in accounts where we group all of the increases and decreases in a specific type of transaction together. We talked about the debits and the credits, and like I said, the debits are on the left, the credits are on the right. They don't mean increase or decrease. You have to use that T account format that we did. So we go through and we talk about how we increase the assets, liabilities, equity, and the dividends and expenses. Actually, I do want to kind of throw this in because they throw a couple of items at you that were new that we didn't talk about last time we were doing the T accounts. They throw common stock and retained earnings and dividends in. So let me just review this real quickly. So again, we're going to do an asset. And they're debits, credits, and we increase assets by what?
Debits.
Debits, and we decrease them by credits, okay? And then they're going to equal the liabilities, or the obligations to pay. And liabilities are increased by credits, and they're decreased by debits. And then we have over here the stockholders' equity. So all this is built, the entire accounting process is built on the accounting equation. And again, we have debits on the left, credits on the right, and we increase stockholders' equity by credits, and we decrease it with debits. Now, we talked about the revenues and expenses, and I want to have those, but there's another level that's in there. Equity, stockholders' equity, is increased by two different groupings. There's something called contributed capital, which is money that the stockholders put in, and then retained earnings, or the increase coming from running their business. So the level I didn't have in there before was where we talk about having common stock. And common stock is where investors, stockholders, put money into the company. They actually contribute cash or contribute an asset. And it's part of stockholders' equity. So if equity is going to go up, common stock would be the same way. We show that as an increase on the credit side, which is your normal balance, and then on the debit, you don't have debits very often, but it can occur. Then you have over here something called retained earnings. And retained earnings are just what the name describes. They're earnings from the company, not just for this year, but for all the years since the company's been in existence, that have been retained in the company. And they all roll up in here into the equity accounts. So again, you increase retained earnings with a credit and you decrease it with a debit. Now, retained earnings is affected by our other two accounts we talked about, our revenues and our expenses. So as we said before, how do you increase revenues? With a debit or credit? With a credit. So an increase in revenues is a credit, and a decrease, which is unusual, is a debit. And then expenses, how do you increase an expense account?
Debit.
With a debit. That's the normal balance. And then you occasionally will have a correction with a credit. But what we didn't talk about last time were dividends. And dividends are when the corporation decides to give back part of the retained earnings to the stockholder. And so what happens is dividends, if we have a cash dividend, for example, we'll go through and we'll give cash to the stockholders, well, cash is an asset. That decreases the asset because cash is being given out, so it's credited. That also reduces the overall equity or value of the company because cash is gone, so the company is not worth so much, so we have to decrease the stockholders' equity. We do that by doing a debit to the dividends. It shows that the dividends ultimately are all going to be rolled up here with the expenses and revenue into the retained earnings. And so the normal balance for dividends is a debit. You don't have credits very often, but if you did, that would be a reduction. So when you debit a dividend, it's going to roll up into retained earnings, reducing retained earnings, and then that's going to reduce stockholders' equity. So these are all examples of specific accounts that are going to be recorded when we're going through and doing our transactions. Now, when we do a recording these types of transactions, they talk about the steps in the recording process over on page 55. And there's 3 basic steps we have to do when we're looking at one of these. We've kind of already been talking about it. There's actually 3 things we need to think about. The first thing is we need to analyze a transaction to see what account is affected and did it increase or decrease that account. So we think about it. And then we go, aha. The second step is to record it or to write it down. And that's where we write it down in something called a journal. And they give an example of a general journal over on page 57. And a journal entry is very simple. It looks something like this. You have a date, you have a debit and a credit, and then you usually have some sort of a description. Now there's also, I don't know if I'm doing it like the one that's in the book, but does that look anything like the one in the book? Yeah. Okay. What you do is, it's a transaction where in the order that the transactions occur, you write them in. So it's a place where everything is listed chronologically, okay? And so, for example, if we went through and we had that transaction in the first chapter where the investors put in, was it $15,000? Mm-hmm. Okay? So let's say that was on January 1st they started. So the description is going to be the account. So cash was increased, so it's going to be debited for $15,000. And then common stock, the cash went up, so the value of the company went up. Common stock was credited, so that increased the equity of the company, so we put it into common stock. And then we write an explanation under here to explain what's going on. So to record contribution of cash by stockholder. And that's important to have because that tells you why this was done. And trust me, if you've ever gone back and looked at a transaction months after you've done it, or worse, somebody else has done it, you're looking at this and you don't know what happened and the accounts don't make sense, it's you're kind of lost. And as an auditor, a lot of our questions would be going asking somebody, why'd you do this? And they go, huh, that's kind of weird. I don't remember, when was that, 9 months ago? I don't know. And then we'd have to sit down and figure out what happened. And usually there was a good reason for it, but it just didn't jump out at you. So this is a journal entry. And so we put that in the general journal. So that's the second step, is going through and recording the transaction. The third step, remember we do these in order. So however, if we had 15 of these on January 1st, they're all listed January 1st. Then January 2nd we had some more, they're all listed. So there's a lot of detail going on. We got to group these together somehow. The third step is where we put them together and transfer the information from the journal, these numbers here and these accounts, into the ledgers. And the ledger is where we have, basically it's like a T account. We show all the debits and credits that affect each account, and then at the end of the period we add them all up to see if there were more debits and credits to see what are any balances. So the ledger is where we take all this detail that's recorded and summarize it, so now instead of having thousands of transactions, we only have a few dozen accounts. And from that we're going to then create the financial statements. So when we're doing accounting, the recording process, those are our 3 steps. Analyze, journalize, put in the ledger. Okay? So that's what they talk about on page 55. And you can go through and you can see a general ledger, a general journal on page 56 where there's some journal entries like I wrote, and on 57. And then over on page 59, you see an example of the ledger account. So in that one, you can see they have debit and credit column and a balance column. And what it does is you show all the debits that came from all the journal entries that affected cash You put all the debits in, you put all the credits in, and then you keep a running balance to see if you have a debit or credit balance. So that's what the ledger is. Now the posting step they have over on page 60, posting is where we take the information from the general journal and we put it in the ledger. That's where a lot of mistakes used to happen. Now this day and age with QuickBooks and everything, you put the transaction in, it automatically posts it to the ledger for you. But in the old days it didn't do that. So you had to put this little reference here, and that little reference was showing that you'd copy this and put it over into the ledger. Okay. They talk about on page 61 a chart of accounts, and they give an example. All the different accounts we want to keep track of where the expenses are, what kind of assets we have, we create an account for whatever information we want to track. And so then all of these journal entries are always going to be to a specific account on the chart of accounts. And they're grouped by assets first, then liabilities, then stockholders' equity, then revenues, and then expenses. And they usually have numbers on them because you'll find over time it's easier to transfer number information because that way you know exactly what it is. Because maybe you use a different number. Maybe you use salaries payable and you use wages payable when you write it because that's how you learned it. They both mean the same thing. Well, you might put them in different places or create two accounts by mistake. But if you both use the same number, you know they're both going to go into the same account in the ledger. So the number helps prevent mistakes.
It's easier to input too.
It's easier to input the type of number than it is an account. It takes a while to learn the account numbers, but eventually you get used to it pretty quickly. Now over on page 62, they go through the reporting process and they have these transactions. And again, I don't really want to spend a lot of time going through those, but what they do have is the idea that you do the analyzing, and you journalize, and then you post to the ledger. And that step of posting, you can see there, that's that last step in each of those transaction boxes. That's a T account. And so that's what we're going to be doing a lot of in this class, is going through and using the T accounts where we do the ledger. So all the debits to an account will show up on the left side of the T account, all the credits will show up on the right side, and then we add those together to see what the balance, outstanding balance is. And actually, you're going to be doing that on the test, so you'll need to kind of practice that a little bit. Let's see. It's actually pretty good examples there. So
The homework on that was extensive.
there was a lot of homework. I'm just trying to see if I want to walk through one of these transactions here real quickly. Well, we've already kind of done T accounts, so I think we're okay. All right. Now, after we've gone through and we have journalized our transactions and we've posted them to the ledger, now we've got this ledger that's got all these outstanding balances. How do we know if it's right? And that's where we talk about the trial balance on page 69. Because the trial balance is really just where we go back through the ledger and we list all the accounts that we have numbers for. We write the numbers down, again in the order, assets first, then liabilities, then stockholders, or equity and revenues and expenses. And then we go though and we put if it's a debit balance or a credit balance. And then we add those two up, and guess what? What do we want it to do? We want our assets and liabilities to balance. Because that's the idea, is every time we did a debit, we had a credit. So we want our debits and credits, at assets and liabilities. I forgot that. We want our debits and credits to balance. And so the trial balance is the first place we go back and see if we made a mistake. And so sometimes we'll catch it. If it doesn't balance, we've got to go back and look and see. Maybe when we carried one of these over, we put it, instead of a debit, we put it on the credit side by mistake. Or maybe we went through and we got tired or interrupted and we posted the credits, we posted the debit, but we didn't post the credit side. So we're looking to make sure that everything got transferred from the journal into the ledger, because the ledger's numbers are what we're going to use for our financial statements. So if there was a transaction during the month that didn't get recorded, that ending balance isn't going to probably balance with the other side of the transactions. Now, a trial balance isn't going to catch all the mistakes. For example, if we wrote down a number wrong and then we carried it over wrong, it's not going to be catching that if we carried it wrong in both places. If we put it in the wrong account, if I didn't pay attention, I did put this in common stock, but I put it in the wrong account, I put it into an expense account, it won't catch that. I'll catch that later on when I'm doing my financial statements. So they talk about some things here. If I posted it twice, I got distracted, and then I came back and I didn't put my reference in, so I ended up writing it in twice. So it's in 2 times, I won't catch that. So there's limitations on the balance sheet, but they're pretty, or on the trial balance, but they're pretty good about going through and helping you find mistakes. They talk about if you have a couple mistakes, it's probably a good idea. If you're off, the difference you're off between the debits and the credits is 9, then there's a good chance that you might have transposed a number. You might have put 26 in as 62. So go back and check to make sure that when you copied this, you didn't put 15 here and 51 over there, because that difference would be divisible by 9. Another mistake is if you're off, take that number and divide it by 2, and then see if that number that you found is somewhere on the in the statements, because you might have taken a number and inadvertently put cash in a debit, and when you did common stock, you might have put it in a debit too. So you might not have put them on the 2 sides. You might have put doubled up one. So there's different ways you can use to try to go through and look for mistakes. But the trial balance is a very useful tool, because it's really our first check, where when we get to the end of the month, we go through and we see, did we get all these things recorded right in our journal, and then get them carried over to our ledger properly. You're going to need to know for the test how to record transactions in a journal, okay? So you're going to have a problem where you're going to have to go through and read the transaction and put it into a journal format, like on page 67, a general journal. And you're going to have to go through and be able to take that journal and put it into the T accounts like we have here, because that's how I'm going to do the ledger. I'm not going to have a ledger format. I'm going to have T accounts. And you'll have to go through and show the journal entry as the debit or credit of the appropriate account. So that'll be on the test. What else you need to know? Trial
And on the
balance.
test, are you gonna have us put it into a trial balance also?
I don't know if I'm going to do that or not. I don't remember. I don't know that. I do that later. I think I have you do that.
Okay.
Yeah. The steps of the trial balance, when you're done, list all the accounts. You always list all the accounts, and then you write their balances in. So the debits are on the left, the credits are on the right. You list them in order. You add the debits and credits. They always have to equal. That's the whole check and balance. So if your debits and credits don't equal, you got to stop and go back and look there. Okay? So that's pretty much in chapter 2. It's the journalizing and then putting it into the ledger, the transactions we talked about how to analyze in chapter 1. So that's what you got for chapter 2.